Welcome back to this Money Control live stream. You're watching Closing Bell with me, Nandita Khemka, and my colleague.
Hello there, I'm Yatin Mota.
Well, Yatin, of course, I'm sure even you would have heaved a sigh of relief, after 6 consecutive days of battering, both on the index and mid-cap level. We've seen some semblance of normalcy return. In fact, yesterday also was a big sell-off. We saw 1.5% cut, and even the broader end of the markets got badgered yesterday, right? Yesterday, the Nifty Midcap index was down 4%, and year to date as well, we've seen a 9 to 10% cut coming in when it comes to the broader end of the market. So today, being a festive day, Makar Sankranti, we had some bit of festivities, signs of that as we saw a rebound on the Lal Street. The Nifty back above that 23,200 mark, and the Sensex as well saw a good recovery, a triple-digit rebound. So it was somewhere around 76,500. The recovery has, of course, been a little more pronounced when it comes to the broad end of the markets because they were outperforming. 2.5% gain when it comes to the Nifty Midcap Index, of course, clawing back from the kind of steep losses that we have seen over the last week. The Nifty Bank Index also, Yatin, made a good comeback, 48,700. It's almost a 700-point recovery. Mind you, the Nifty Bank Index has also seen quite a bit of a badgering. Is down 6,000 points from its lifetime high. But in terms of sectoral action, IT and FMCG, the defensive, so to say, got hammered today. And IT, of course, we had a reason, HCL Tech, that was dragging the entire pack down, and of course because after TCS results we've seen a good up move in the IT pack, so there some bit of profit taking coming in. But the good part is, Yatin, we didn't really see a sell-off on bounce. Sell on rise kind of situation didn't happen today. We were able to sustain those opening gains. Metals and PSU banks, those were the top two gainers today sectorally. PSU banks, Yatin, last week 8% down. Today some of the PSU banks saw very good buying action, including the likes of SBI, that was among the top Nifty gainers today. It's 2 to 3% kind of gains coming in on that particular stock. Aside of that, Adani Group stocks were quite active today. Some of the stocks clocked in double-digit gains. Adani Enterprises, Adani Ports were the top gainers on the index. Metals were doing fairly well today. 3.5% gains on the index. So Hindalco was up. Shriram Finance, NTPC and BEL, these were some of the other movers. On the other hand, HCL Tech, of course, saw its biggest single-day fall in almost a decade. Top Nifty gainer. I beg your pardon, loser, lost somewhere around 9% or so. HCL, Apollo Hospital, Titan, TCS, Ultratech Cement, these are some of the other laggards. But Yatin, as I mentioned, PSU bank names, even from the broad end of the market, the smaller ones were also quite upbeat today.
Absolutely, and the advance decline ratio of the markets was much better. Yesterday was almost 1 advance for 11 losses, but today the market breadth really changed, 3:1. So, good move coming in for the mid-cap end of the market. Now, if you look at the Adani Group stocks, clearly making the headlines. If you look at Adani Energy Solutions, Adani Power, Adani Total Gas, all of these stocks are moving anywhere between 5 to 15%. In fact, the PSU stocks, the smaller ones, also moved after the Bloomberg report suggesting that the government might look at or allowing a dilution, in a few of these PSU banks when it comes to fundraise. So IDBI Bank, Central Bank, UCO Bank, Indian Overseas Bank, Bank of India, all of these stocks saw intraday move of nearly 20%. So good momentum coming in there. What was not doing well obviously is the IT pack, including HCL Technologies, which was accident of the day. United Spirits, after the exit of the CEO and top level exits, that stock saw a 5% cut coming in. Vijaya Diagnostics as well as the LTI Mindtree were the other stocks which were suffering in trade. But yes, the action on the Lal Street clearly continues. But selectively, if you look at stocks like SW Solar, Cello, Sanofi, all of these stocks are now at 52-week lows.
All right, those are the movers and shakers. Quite a few gainers and quite a few losers as well. But as the advanced decline ratio suggested, more gainers today for a change. Good to see that. But on that note, let's take a look at some of the movers that are on our radar this afternoon. Of course, the first one has to be HCL Tech, as Yatin mentioned. Accident of the day after the kind of reaction we saw to TCS. One could say that this was kind of a surprise, but it was pretty much evident by the commentary from the management, although they have said that in terms of demand environment things are much better than what it looked like 3 months ago. But they've also pointed to some bit of expected weakness in the fourth quarter, which is what may have roiled the street when it comes to IT stocks. Revenue guidance is something that has underwhelmed street, and street is fairly unimpressed because the guidance upgrade was fairly marginal, and that too they tinkered with the lower end of the guidance. So they brought it up by a good 100 basis points from 3.5% to 4.5%. So the guidance now stands at 4.5% to 5%. The narrowing of this band is something that the street didn't like, because the top end of the guidance was left unchanged. Now they have, the revision in fact in the guidance was capped, because the management has pointed out that some telecom deal scale down may happen, and discretionary project delays may also happen. Because of that, the fourth quarter may be a little more subdued, and which is what didn't really sit very well with the street. In terms of management commentary, they have said that all round they are pretty much positive about the fourth quarter, but margins may also get slightly impacted due to the senior level wage hikes. In fact, they see a 50 to 60 basis point margin impact because of the wage hikes, which is why they haven't really, made any changes to the margin guidance. This quarter, margin was at 19.5%. That was above estimates and above the guided band as well. But still, no changes to the margin guidance, and that is another factor that may have impacted sentiment. Expect fourth quarter margins to be slightly lower than the third quarter margins, although they have seen good momentum in small deals. Large deal conversations have been pretty slow, but they should come back in the fourth quarter to first quarter of FY26. Aside of that, if you look at some of the brokerages, most of them have been on the sidelines, no tinkering with their calls. CLSA has a hold call. Target price is at 1882 rupees per share. They are disappointed with the guidance. They were hoping for something better amid improved demand environment. Jefferies, on the other hand, hold call here again. Target price, although is above 2000 rupees, they have cut their revenue and EPS estimate by 1 to 2%, and they have said that rich valuations and worsening year-on-year constant currency revenue growth, these are some of the factors that have compelled them to stay on the sidelines when it comes to HCL Tech. Aside of that, if you look at Nomura, they were a little more bullish, although they have retained their buy call. Target price is at 2000. They believe that generative AI demand, in fact, will drive demand in the legacy tech modernization, data and cloud as well. And lastly, Morgan Stanley, even they are fairly bullish. They've said that the lower than expected revenue guidance has been offset by the positive commentary by the management. But I want to just say that Kotak Equities, that has cut its FY25 to FY27 estimate by 1 to 4% on the revenue side. And they've also pointed out that valuations are looking full. And of course, the stock has seen a good run along with other IT stocks. Last year, in 2024, the stock gained somewhere around 30%. So you could say that whatever little, good thing that you saw in the earnings may already have been priced in. So valuations wise, brokerages have pointed out that it is rich, and also the fact that guidance was disappointing. These are the two factors that triggered like its biggest single day fall in almost a decade.
I think 10 years, one of the largest intraday falls. The key takeaway from brokerage notes was obviously higher valuations and the organic revenue. The acquisitions are probably driving the much of guidance hike, which the probable trader reason why the stock was hammered in trade today. But BSE Limited, this is one stock which is on our radar. Jefferies today upgraded the stock to hold. The target now has been revised to a level of 5250. Obviously, after the SEBI curbs on the future and option trade, a lot of volume loss was expected. But probably, stocks like BSE still haven't seen a big blip in their, overall turnover. In fact, Jefferies say that the SEBI's new F&O measures impacted options volume by nearly 70%. However, the premiums are down by, 10% in Jan, the month to date versus estimates, as the traders move to larger average ticket size. So, in general, we have seen a shift of volumes. NSE, BSE both have seen peak volumes drop, but still, a lot of, juice is left on the table according to Jefferies when it comes to valuations and earnings. In fact, exchanges gain with the stable top line and large margin expansion on the back of better premium quality. Also, there is anticipation that both BSE and NSE would increase transaction charges, which are, taken by exchanges for options and cash trades. So this is something that the street is now anticipating. In fact, discount volumes can see a 40% hit and will see a large price hikes. Most of the brokerages which were giving you an option for zero brokerage on delivery, they have also started charging 20 rupees per trade. So overall, I think the industry will try to protect its margins and profitability by increasing transaction charges or probably brokerage charges, which will eventually pull up earnings according to brokerages, and that is the reason why Jefferies today upgraded the stock of BSE. The stock was up nearly 5% intraday in trade.
That's true, I think that was about BSE, but Goldman Sachs, I think yesterday came out with a report on BSE where they had pointed out that valuations, although are in line with global peers, but could be on the a little bit of on the expensive side, because a lot of brokerages are pretty much divided on where the stock is headed from here. But as Jefferies pointed out that it's discount brokerages that will bear the brunt of the new F&O regulations, and that's where the major hit will come. But BSE of course is expected to wrench market share from NSE, right, because of fewer expiries any which ways. So yes, maybe valuations wise it could be a little iffy, but otherwise I think brokerages, some of them are especially upbeat on BSE's prospects. But from BSE, I have another stock on my radar, that's Mahanagar Gas. Back in November, it was getting difficult to make an investment case for some of these gas stocks after government reduced allocation of APM gas, that's a cheaper gas, by 40% in 2 consecutive months. But recently the government has reversed some of that and restored some APM gas allocation. At least for MGL it is somewhere around 26% or that or so. Today we had a report from Morgan Stanley coming in where they have initiated coverage on the stock with an overweight rating and a target price of 1606, which implies a 31% upside from yesterday's close price. Now the reason behind that is the fact that gas adoption will only go up, and MGL will be a key facilitator of that. This is a main factor why Morgan Stanley has upgraded the stock. It has pointed out that Mumbai as a city is an ever expanding city and it has rising travel and energy needs, and natural gas is in fact considered as the fuel of the future for Mumbai. As I mentioned, Mahanagar Gas will be facilitating this adoption while aggressively capturing market share as well to service a 125 billion mile market. And Morgan Stanley has actually called it a Tesla-like moment for both Mumbai and MGL, where gas adoption is concerned. In fact, Morgan Stanley expects global gas market to remain balanced in 2025 and get oversupplied by 2027. Now, the company in particular, MGL, has a fifth of its gas sourcing linked to LNG, which is more expensive than APM gas, which is why margins could be lower, but volume growth will be key going forward. According to Morgan Stanley, they said that structurally volumes are expected to be higher, and higher volumes will be the key to re-rating. But as I mentioned, the government has restored some of the APM gas cut as well, so that would also bode well. Although gas companies had also taken a price hike, but that was being looked upon as meager to offset the kind of cost they would have to incur to acquire costly gas. But now that could come down a little with the restoration of APM gas allocation. But of course, aside of that, city gas distributors will begin receiving the increased volume of domestic gas from the 16th of January, which is which is just 2 days away. But if you look at the stock, Yatin, from November lows, the stock has given a good 13% return. So the investment, it may be easier to make an investment case for some of these gas companies now that all those setbacks that they have witnessed seems to be abating, and with the gas adoption angle also coming in, looks like MGL could be poised for more upside. But let's see how things really pan out. But after the kind of correction they have seen, some of them may look good on the valuation front.
Absolutely, and the issue was the supply disruption in the APM gas quota, which was reduced by the government. But I think the government has realized the problem. They have asked GAIL to increase the overall supply to city gas distribution companies, and I think MGL, IGL, all of these companies had intimated to stock exchanges that the share of domestic supply has now increased from close to 37% to 51%. Most importantly, as you were pointing out, the cost of gas probably could be high, putting margins under pressure. But I think apart from GAIL, ONGC has also been asked by the government to really ramp up the supply to city gas distribution companies for a better volume offtake as well as better pricing. So yes, it's a blip from the government on the APM gas front. Hopefully, as Nandita was mentioning, the correction offers some bit of value to investors who can probably look at investing companies like IGL, MGL, especially MGL, wherein we could see a Tesla-like movement, according to Morgan Stanley, when it comes to the domestic gas supply as well as consumption.
Well, that was about all the stocks that were on our radar this afternoon, but we are ending the day on a good note. In fact, feeling better than what we felt over the last 6 days. Let's hope, it picks up momentum from here and we don't see a sell-on rise kind of situation arising again tomorrow. But we have a whole host of big earnings to watch out for this week. Thursday itself, you have Reliance Industries, Infosys and Axis Bank. So, big chunk of Nifty weight will be reporting numbers on Thursday. Tomorrow, it's HDFC Life. So, yes, earnings will also be trickling in and we'll be reacting to that as well. But for now, time to say goodbye. Thanks a lot for tuning in. Have a great evening and come back and join us again tomorrow morning. See you on the other side. Thank you for watching.